Well, welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And this week we're going to have a special treat as I'm going to give a preview or a trailer, if you will, of some of the talks from next week's DIY Investing Summit. And so basically each one of the real talks is going to be 45 minutes to an hour long, but I've taken different kind of simple highlight segments or excerpts from several of these interviews, and I'm going to be sharing them with you this week to give you a taste of what the summit's going to be all about. Every one of the segments you'll hear this week are all self-inclusive. You don't have to have the rest of the context to understand them. They all have their own value add in themselves. But they also give you a glimpse of, if you like this, imagine what the rest of the summit, the rest of the interview, and the rest of all the combined interviews in the summit may be to you. So again, visit DIY&nbsp.com, DIY&nbsp.com to get signed up. It's free for a limited time, so don't forget to go jump over there soon. And the summit officially starts Monday, January 23rd, so don't forget to sign up, DIY&nbsp.com, and hope you enjoyed today's preview for that summit. And this episode's special summit guest is Chris DeMuth. So if you were asked to give a state of the markets address to U.S. investors going into 2017, mindful this will be aired in January of 2017, what would your main points be in that state of the markets address?
As of today, and this could certainly be different by then, let's see, the Dow is just teetering beneath 20,000 for the first time. The markets are fully priced. You know, if you look just overall at the market cap in the U.S. is over 1.25 times the GDP. Markets historically have a negative return prospectively from such heights, and heights that they've gotten to very few times in history. The cyclically adjusted PE ratio over 28, that's 69% above the mean, which is 17. Again, negative from that. And we have a bursting bond bubble. So with credit tightening, I think that a lot of the things that people think they know about the equity market might be chopped up into very precise little packets of data, but it's a sample size of one, with the long bond going from 15% to 0% from the mid-'80s to today. And if it does the opposite between today and the next quarter century, it could be a very different scenario. So markets are high, they are risky, and they are precarious.
So what do as far as the markets being overpriced, I mean, that's something that people have been discussing for a while. So it's not a new idea, but when I hear that, I think if I want to invest as a fundamental investor, then I need to make my decisions based upon fundamentals, obviously. And so when I see that the markets are overpriced like they are, obviously there can still be value found in those markets and individual equities and other opportunities. But generally speaking, it only makes sense, in my opinion, to obviously be very cautious. But then it's hard when you're in that place and it's like, well, things have been overvalued for 1 year, 2 years, the market keeps going up. And so to me, it seems like it sets up this equation for people are cautious, then they just say, well, screw it, the market keeps going up, so I'm jumping back in, and that's when everything bad happens. That seems to be like the historical, fly doom loop that keeps happening. Do you kind of feel that as well and anticipate a similar type dynamic?
Oh, absolutely. No, this thing will suck in everybody before it's done. But just because the environment is dramatic doesn't require any sort of dramatic response. My reaction is really just kind of redoubling what my reaction would be normally, which is caution and adequate margin of safety, and just underpay enough that gives you a lot of flexibility in a lot of ways to win. That if you underpay by substantial margin, it requires a lot less precision than if you have a little sliver. If you're right next to a cliff, you have to walk very carefully. If you're a long distance away, you can be a little bit more casual. And so I think that finding individual situations where everybody's panicking or nobody's paying attention always exist. And frankly, I wake up in the morning and an average day, I think I have 5 days of research that I'd love to get done before the sun gets down. And so If it's fewer than that, maybe it's 2 or 3 days, but I always have something to do, and I always have to kind of triage and prioritize my day. So, there's always something to do. In theory, I would be in cash if I didn't have very compelling ideas on an absolute basis, but in practice, that never happened.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.